Welcome to the Hurst Trading Room. My name is David Hickson and this is a video update for the 19th of January 2015. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. If you are watching this video anywhere other than on our iTunes or YouTube Hurst Trading Room podcast channels, then make sure you subscribe to those channels because you will receive notification as soon as I publish one of these videos. And you can also share the videos with friends and so forth, which is, of course, a fantastic thing to do. Before we get to take a look at the markets, I'd like to remind you to join the conversation. We have started testing a new way of talking about Hurst cycles and interacting, and that is something called Spot IM. There is a small Spot IM circle at the bottom of each one of our website pages, and if you click on that you can get chatting. Please do get involved in the conversation. One of the most rewarding things about the work that I've been doing over the last several years has been having conversations with other people who are interested in Hurst cycles. So let's start speaking about the markets. Now, last week I spent a good deal of time discussing the bearish signs that were appearing in the stock markets. And sure enough, last week turned out to be a pretty bearish week in that the US markets, this is the S&P 500, as you can see last week headed down again, potentially formed a bit of a trough on Friday. Perhaps that is the trough of the 40-day cycle that we are expecting to form soon. It could have formed last week on Friday. It might still form sometime this week. But something very interesting happened in the markets last week, and that is that there was a very big divergence between the DAX, the German markets, and in fact all European markets, and the US markets. The US markets, as you can see, generally went down, and on the other hand, the DAX, let's take a look at that, reached up to new highs. Here is roughly the same sort of time period in the DAX, and you can see that the DAX on Friday reached a new high. Far from forming a trough on Friday, it reached up to new levels. And of course on Thursday the Swiss National Bank announced that it was unpegging the Swiss franc from the euro, which caused a great deal of volatility, not only in the forex markets but also in European markets and markets around the world. There was a lot of volatility because of that announcement, and you can see that on Thursday. Let me just clear that arrow. Thursday was a very interesting day, great deal of volatility in the DAX, but on Friday the DAX continued moving upwards. So there is a very clear divergence between what is happening in the DAX and what is happening in the S&P 500, or generally what's happening in the European markets and what's happening in the US markets. Now, you know that Hurst published his cyclic principles, and one of them was the principle of commonality, which tells us that markets move with a great deal in common. Which means that we generally expect markets, similar markets, to move in fairly similar ways, and most of the time they do. There are obviously subtle differences, but when a market in Europe achieves new highs and the markets in the United States don't, that gives us reason to sit up and take notice and ask ourselves what is actually happening. Is it possible that the cyclic analyses between these two markets is slightly different, and therefore we're seeing different things happen? Or is it simply a byproduct of some of the emotion that tends to happen when markets turn? Now, when markets form long-term troughs or long-term peaks, there is often a lot of emotion, and sometimes markets behave in slightly unusual or unpredictable ways. You will know, because I've been speaking about it over the past few months, you will know that I believe that the markets are forming a very important peak at the moment, or at least sometime within this sort of 6-month period. I think that a very important peak, a peak of the 9-year cycle, is forming, and as that peak forms there is likely to be a lot of emotion, and divergence between these markets is something that we would actually expect to see. Despite the principle of commonality, we will expect to see divergence, because divergence happens at times of strong emotion, which happens when markets are forming peaks and also troughs, but to a lesser extent. To a greater degree, it happens when the markets form peaks. We see divergence between these markets. But it prompted me to take a look at the analysis in both the US stock markets and also in the European stock markets, and to consider some of the alternatives. And there's a very interesting alternative that has been on the table for some time, and I'd like to discuss that in today's video. I'd also like to discuss how the fact that there is a strong possibility that a different analysis is taking place in the markets or is playing out, how that in fact does not affect our trading. It affects our trading to a small extent, but not to a very great extent. And that's one of the reasons why I really enjoy analyzing and trading markets using Hurst cyclic principles. Because even when there is analysis uncertainty, you can still make clear and simple trading decisions. And it's a very important thing for me, and I often speak about it, and I would like to spend a little bit of time pointing out how this works in today's video. So let's take a look at the S&P 500, and let's first of all consider some of the details of the analysis that I've been discussing over the past few months. And here you can see the 18-month cycle trough, which formed in October, the middle of October. Now, that is a very viable position for the 18-month cycle trough. And since then, of course, we've seen one 80-day cycle, a very good, clean, beautifully shaped cycle, which formed its trough here in the middle of December. So that was an 80-day cycle. I don't believe there's much to debate about that. I think that's very clear, very simple. Since then, we saw a 20-day cycle, which formed its trough in the first week of 2015. And of course, since then, we've seen a sort of a miserable failure for the next 20-day cycle trough, which was not unexpected because of all the bearish signs that I pointed out last week. I'm not going to go through them again. Take a look at last week's video and you will see all those bearish signs that were there, indicating that things were turning bearish and turning to the downside. Of course, we are expecting a 40-day cycle trough, and let me just clear that, and you can see the 40-day cycle trough is in fact expected this week. The circle is right in the middle of this week, probably about Tuesday or Wednesday, but the line to each side, which indicates the range of time that trough could be expected, and let me just zoom in a little bit, that range of time, as you can see, is going right back into last week, and so the formation of that 40-day cycle trough is certainly quite possible on last Friday. But I'm not going to speak too much about that now, because I'm more interested today in discussing the slightly bigger picture. So this is the analysis that we have been or that I've been discussing over the past few months, and it's very viable. There's nothing wrong with it. But I'd like to point out something fairly interesting, and that is this next expected 40-week cycle trough. Do you see this, what we call a circle and whiskers? The circle is over here for the 40-week cycle trough, and the whiskers are the lines to each side of it. Now, the circle represents the actual day or actual time at which the next 40-week cycle trough is expected to occur. And the lines on each side represent the range of time in which that 40-week cycle trough is expected to occur. Now, do you notice something else about that circle and whiskers? Well, sorry, I haven't pointed out anything about that circle and whiskers yet. The first thing I'd like to point out is that it's a very wide range of time in which that 40-week cycle trough is expected to occur. That circle and whiskers pattern continues over a really long period of time. That's the first thing I'd like to point out. The second thing I'd like to point out is that it seems to be floating on its own. We expect to see nests of lows, and you can see a nest of lows here for the 20-week cycle trough. Quite a nice, neat stack of those circles on top of each other with fairly good, neat whiskers or lines on each side, forming an inverted triangle. Now this 40-week cycle circle and whiskers is floating on its own. It isn't entirely, of course. It is connected to this nest of lows over here. But my point is that it's slightly displaced, and it's not a very neat nest of lows. What does that mean? Well, it indicates that there's been a fairly strong shift in the wavelength of cycles recently. And the reason for that, I can tell you, is because this most recent 18-month cycle, if that was indeed a trough of the 18-month cycle in the middle of October, was a very long cycle. And so those cycle wavelengths are being stretched and distorted. So that is a reason for us to question this analysis. And I've been questioning this analysis ever since October, and so have other people. And I hope that you're keeping an eye on the analysis that is written in the Hurst Cycles website, hurstcycles.com. There's a lot of very, very good analysis written there, and some analysts have suggested that the trough in October was not a trough of the 18-month cycle, but a trough of the 40-week cycle. That's what I'm going to discuss in a little more length, a little more detail today. But let's take a step back and take a look at that 18-month cycle, which I have been speaking about as forming a trough in the middle of October 2014. Here is that cycle. Let's turn on the semicircles, which make it a little easier to visualize. Okay, so there is that 18-month cycle, of course, from November of 2012, which we have as a 4.5-year cycle trough. And there is that 18-month cycle, which then formed its trough in October of 2014. Now, it's an interesting cycle. It's a difficult cycle for a Hurst analyst to really analyze with a great deal of confidence, and I'm sure you can see that because price moved in very much a straight line up for a very long time. There were, of course, troughs during that period, but there weren't any really very big and very obvious troughs. The biggest and most obvious was this one in December of 2014. Now, when you have a price movement like that, it makes cycle analysis just a little more tricky. Not impossible, but a little more tricky. This analysis is a very good one, a very viable one, and I've been following it and trading on the basis of it for some time. But there are a few obvious problems with it, and that 40-week cycle circle and whiskers is the first clue that maybe things aren't quite as good as they should be in terms of this analysis. What are some of the other problems with it? Well, for me, a very big problem is this prominent trough in February of 2014, which you can see in the analysis isn't actually phased as being a trough of a big cycle at all. Now, that's a very big problem for me. Of course, we could shift things around and we could pin some troughs and we could say, well, that's probably actually the 40-day cycle trough and we should shift things over a little bit. Yes, of course, we could sweat the details if you like, but that's a bit of a warning sign for me that perhaps this analysis is not the correct one. Perhaps it's not absolutely correct. Now, often when I speak about an analysis not being correct, it sends shivers of fear down people's spines because they think, oh no, the analysis is incorrect. That means everything I'm doing is wrong. How can I make trading decisions? The really important message I'd like to make in this video is that it is still perfectly possible to make sensible trading decisions even when there is analysis uncertainty. And you should never be frightened of analysis uncertainty. I'm going to speak about an alternative analysis which has the trough in October of 2014 as a trough of only 40-week magnitude. Now that sounds like a really big thing. When you have a change in magnitude from 40 weeks to 18 months, wow, that sounds like a really radical change to the analysis that we're looking at. In fact, it isn't, and I'm going to come back to this point later and explain why it makes very little difference to our trading decisions. Some analysis questions obviously directly impact your trading. Some analysis questions, however, tend to be of more academic interest and a longer term interest. I shouldn't say academic interest, but longer term interest. And so I'll be speaking about that. So let's take a look at the alternative analysis, which is this analysis over here. Let's take a look at what's happened recently. You can see that I'm now saying that this trough in the middle of October 2014 was possibly only a trough of 40-week magnitude. What has happened since then? Well, we've had an 80-day cycle trough exactly as we did in the other analysis, forming an 80-day cycle trough in the middle of December. Then we had a 20-day cycle trough, and then we were expecting a 40-day cycle to form a trough at roundabout now. Here is where things are ever so slightly different, but not very different. The first thing that I'd like to point out in terms of the difference is a fairly obvious one. Here are these very neat nests of lows. You see that? These are what nests of lows should really look like. They cannot always look like that, I must tell you. The fact that these are better nests of lows doesn't automatically mean that this is the obviously correct analysis, whereas the other one is incorrect. But this would certainly lead me to believe that this analysis might be a better one. We don't have the problem with the 40-week cycle circle and whiskers stretching over and sort of hanging in the middle of the space between two nests of lows, which is what happened in the other analysis. So that's one good point in terms of this analysis. Let me zoom in first of all, and we can point out something else that's fairly interesting over here. The 40-day cycle trough, you can see according to this analysis, was in fact expected on about Thursday or Friday of last week, and that is exactly when a trough did occur. That's another positive aspect of this analysis, in my opinion. Again, it doesn't mean this analysis is definitely correct, but it's certainly a step in the right direction. Now let's take a step back with this analysis as we did with the other one and compare them. Here we go. You can see the big difference with this analysis is that I have pinned the 18-month cycle trough to the February 2014 trough in price. There it is. That was the trough in price that caused me some problems with the other analysis, you will remember. Now, what does that mean? Well, it means that from the November 2012 trough until February 2014, we had an 18-month cycle. Following the formation of that 18-month cycle trough in February of 2014, we had a 40-week cycle, you can see over there, play out and form the trough in October of 2014. Now, let's just measure that 18-month cycle trough from November of 2012 until February of 2014. You can see it played out at 14.7 months, which is in fact the recent average wavelength of the 18-month cycle. That's another positive, in my opinion, in terms of this analysis. In the other analysis, of course, we had an 18-month cycle that played out at about 23 months. Now, it is perfectly possible that an 18-month cycle stretches to 23 months, which is why the other analysis is not impossible. But I must say, I prefer this interpretation with the 18-month cycle trough playing out at the recent average length of 14.7 months. Of course, there are issues with this analysis as well. For instance, let me point out this 20-week cycle trough, which has been phased as taking place in June of 2014, and here is the trough in price. Now, that's a really tiny trough in price. Was it really a trough of the 20-week cycle? Well, again, we could shift the troughs a little bit to the one side or to the other side in this analysis, but the fact is that there was a period of time during last year, that's that period of time over there, where it is very difficult to find any longer cycle troughs. And so that is a disadvantage of this analysis. But you will probably see that any Hurst cycle analysis has things that are advantages to the analysis, and then there are going to be aspects of the analysis that are not perfect. That is a reality of analyzing financial markets. It's very difficult to find an absolutely perfect 100% in every tiny detail analysis. However, as I've already mentioned, it doesn't mean that we can't make good trading decisions. But now let's compare these two analysis options and see what difference it makes in terms of what we're expecting to happen in the US stock markets. First of all, let's stay with the new analysis that I'm presenting, which has the 40-week cycle trough in October of 2014. And I would like to show you a very interesting FLD line. Now, you know that I like to trade the 20-day FLD, but this is the 54-month cycle FLD. And the FLD trading strategy, which trades interaction between price and the FLD, applies to any cycle. Things get a little more complicated when you have different harmonic ratios. I'm not going to go into the detail here, but I'd like to just display that FLD because it's going to come into this consideration of the longer term picture. Now, this chart starts all the way back in 2009 when there was a trough of, I believe, at least 9-year magnitude. What has happened since then? Well, we have had 1.5, roughly, 4.5-year cycles, and of course the 9-year cycle peak I am expecting to form in the markets at the moment, or perhaps it has already formed, and then I'm expecting price to come down into the next 9-year cycle trough, which you can see according to this nest of lows is expected sometime towards the end of about 2016, very roughly. Let's take a look at the 18-month cycles that have played out since then. And remember, this is the analysis with the 40-week cycle trough in October of 2014. So first of all, the first 18-month cycle that followed the 2009 trough was a very bullish 18-month cycle, as you can see over there. Then we had a fairly neutral shaped but slightly bullish 18-month cycle. That was the second one. And at that point, price came back down to the 54-month cycle FLD. So let's quickly speak about that FLD. Remember that the first time that price interacts with the FLD following a trough of high magnitude, we label an A category interaction. So I'm going to do that. That is the A category interaction with this 54-month cycle. My pen won't write A. There we go. This is the A category interaction with the 54-month cycle FLD. Right? What do we expect from an A category interaction? We expect price to go up. Right. Then price comes down to the FLD again in a B category interaction. And I'm suggesting that this is the B category interaction over here in about late 2011. Then price tracks along the FLD. Now, it didn't actually track along this FLD, as you can see, but it was fairly close, or certainly running parallel to the FLD from late 2011 until late 2012. So that's by no means a tracking action, but it's a fairly parallel price movement. And then we had price pull up away from the FLD. That is what I believe was probably the C category interaction. And for that reason, this 18-month cycle, this third 18-month cycle that played out over here, was in fact not a bearish shaped cycle, but was a fairly bullish shaped cycle. Now we could discuss all the details of that, but let's just keep going in terms of this consideration. Then we had another formation of a 54-month cycle trough in about November of 2012. And following that trough, we had a very bullish 18-month cycle, which is, of course, exactly what we would expect following the formation of the 54-month cycle trough. What have we seen since then? Well, we've seen, as I've mentioned, the formation of a 40-week cycle trough in October of 2014. And so we are now in the second 18-month cycle. Now, the second 18-month cycle of a 54-month cycle is expected generally to be a fairly neutral-shaped cycle. So there we get the M shape over there. So I'm expecting a fairly neutral shaped cycle, which means I'm expecting the market to come down into this 18-month cycle trough, which is expected in about May or June of 2015 of this year. So remember that, because we're going to compare these analyses. And this analysis tells us that we're expecting a move down into a trough in May or June of this year. to form the next 18-month cycle trough. Then let's take the next step, and we are then expecting a bearish 18-month cycle to form and to bring price down to the 54-month cycle trough, which, as I've already mentioned, we expect late 2016. In the process, what do we expect it to do with this FLD that we have plotted on the chart? Well, we've seen an A category interaction, B and C. The next interaction is a D category interaction, which forms as price crosses down below the FLD and heads down to a trough of the same magnitude as the FLD itself. In other words, a 54-month cycle trough. And that is exactly what we are expecting. We expect the trough to be at least one magnitude greater, in other words, a 9-year cycle trough. And that's exactly what I am expecting, a 9-year cycle trough to form towards the end of 2016 or perhaps even early 2017. But now there's an important thing that we expect out of that D category interaction as price crosses down below the FLD. We expect that price cross to generate a target for the formation of that trough. And that target will be from the peak. Let's assume that the peak has occurred, just for the sake of this discussion. So from that peak down to the cross, which we don't know where that cross is going to happen yet, but let's assume it happens at round about the level of 1800. That generates a target of about 1600. So, to summarize, this analysis with the 40-week cycle trough in October of 2014 tells us to expect a move down now into an 18-month cycle trough in about May or June of this year, 2015. Then, of course, we will expect a bounce, but then we expect a bearish cycle to carry us down to a low of about 1600 in late 2016. That's the big picture. Now let's do the same thing with the other analysis. Here is that other analysis. And the big difference is, as you can see, that there was an 18-month cycle trough that occurred in October of 2014 instead of a 40-week cycle trough. Now let's look at those 18-month cycles. Here is the first one, a bullish one. Here's the second one, a neutral-shaped cycle, slightly bullish. Here is the next cycle, 18-month cycle, which was, of course, expected to be bearish, but turned out to be a bullish cycle. Why? Well, because we have the same or very similar interactions between price and the FLD. Here is the A category interaction, which you can see happened very nicely and very neatly right in the middle of this move up from this 18-month cycle trough up to that 18-month cycle peak over there. And here is probably the B category interaction as price came down and almost touched the 54-month cycle FLD. And here somewhere is the C category interaction as price pulled back up away from the FLD. What do we expect next? Well, we expect the D category interaction in terms of price interacting with the FLD. But let's take a look at the 18-month cycles. There is the next 18-month cycle, which is a much longer cycle. It's a very bullish cycle as expected. What do we expect now? That's the important thing about this discussion. Well, now we are expecting the second 18-month cycle to play out. We expect that to be a fairly neutral shaped cycle. So the price has been going up. We expect this to be a neutral shaped cycle with a trough forming in early 2016. The 40-week cycle trough is expected around about the middle of this year. So in terms of the M shape of the cycle, we expect price to come down into about the middle of this year, and then we expect it to bounce up again. It might form a new peak because this is a fairly neutrally shaped cycle, and then we expect it to come down and form the 18-month cycle trough in about early 2016 probably. Then we expect the next 18-month cycle to give us a bounce up, but it should be a bearish cycle, and then we expect it to come down into the 54-month or 9-year cycle trough, which is expected later according to this analysis, of course, and that's in late 2017. What's price level do we expect roughly? Well, it depends where the peak forms. It might not have formed yet, and it depends where price crosses the FLD, which it hasn't done yet, of course. But according to this analysis, it looks as if though the price crossing of the FLD might occur later, which means that it will probably occur at a higher level. Therefore, the projection to the downside will not be as deep, but we might have seen a higher peak. So it might be an equal size projection down to the low, but certainly it looks as if though it might be a little bit higher, perhaps round about the 1800 level rather than the 1600 level. So what are the big differences in terms of the big picture here for this analysis? Well, according to this analysis, we are expecting price to come down towards the middle of this year. It will not be an 18-month cycle trough as the other analysis expects, but it will be a 40-week cycle trough. So we're expecting a move down now into about the middle of this year. Then we're expecting a bit more of a bounce up. So this analysis is a little more positive in terms of what's going to happen in this autumn for the northern hemisphere of this year. In other words, September, October of this year is looking a little more positive. We might see some new highs later this year. But in terms of the longer term picture, we are still expecting a strong move down. You see this line over here, we're still expecting a strong move down into a 9-year cycle trough late in 2017 or perhaps even early 2017. So that is the bigger picture between these analyses. I hope you can see that even though we've moved the 18-month cycle trough and substituted it with a 40-week cycle trough, there is not a great deal of difference. There are some subtleties to the cyclic picture, but it's not a completely different analysis. I'm still going to come back to what difference this makes in terms of our trading, but let's quickly speak about the divergence that happened between the DAX and the US markets, and discuss why, in fact, that could have happened. And this video is already really long, so I'm not going to dwell on the details here. But this is, I believe, a very viable analysis for the DAX. It's the analysis that I believe is most probably playing out. It is very similar to the analysis in the S&P 500 that we've been looking at. And of course it supports Hurst's principle of commonality, that markets move with a great deal in common. But there are some subtle differences, and the one thing I'd like to point out is that according to this analysis, the 54-month cycle trough, which in the S&P 500 was in November of 2012, in this analysis in the DAX, it is phased as occurring in April of 2013, so about 4 months later. We could debate that, but let's not spend time doing that. What it does tell us is that it's much more likely that the trough that formed in October of 2014, this trough over here, was almost certainly a trough of the 18-month cycle. Phasing that trough as a trough of the 40-week cycle is fairly difficult to do. It doesn't work so well as an analysis. So what does this analysis tell us? Well, it explains a possible reason for the divergence between the US markets and the DAX. And that is very simply this. Here you can see the shapes of the 18-month cycles that I showed you in the US markets. First of all, a very bullish 18-month cycle. Then a neutral shaped 18-month cycle. In fact, a slightly bearish 18-month cycle. Here is the A category interaction between price and the 54-month cycle FLD, the orange line over there. The B category interaction shows a really very accurate moment where price came down to that FLD and found support at the FLD. It did that not once, but once, twice, 3 times, and 4 times. So it came down to that FLD several times, finding support at the FLD. So although this doesn't show a period of time where price was tracking along the FLD, the fact that price kept finding support at the FLD is a similar concept in many ways. And so I would call this a fairly tracking sort of an action, and therefore our C category interaction occurs over here. What are we expecting next? Of course, the D category interaction, which is still coming up. Then because of this tracking action that happened over here, we had a fairly bullish 18-month cycle. Then we had another bullish 18-month cycle which took place over there. And now we are expecting a fairly neutral shaped 18-month cycle. Do you notice how this analysis, and I'm going to draw a rough sort of an M shape over there, of course is very similar to the analysis in the S&P 500 with the 18-month cycle trough in October of 2014. But it certainly explains why it's very possible, very valid, that the DAX has reached new highs last week. It wasn't a very unexpected occurrence, because we are in the first stage of an 18-month cycle here. The fact that the S&P 500 and the other US markets didn't achieve new highs last week makes it, in my opinion, slightly more likely that the October trough in 2014 was of only 40-week magnitude. And so this longer-term picture shows us how the divergence between the DAX and the S&P 500 is explained by this difference in the analysis. What is the longer-term picture? Well, I have in fact already spoken about the longer-term picture in terms of this analysis in the S&P 500, so I won't dwell on it. But this market is going to form a peak sometime soon. It probably hasn't formed that peak yet. But it will form that peak sometime, I expect, during this year. It's going to come down to a 40-week cycle trough around about the middle of this year. It's going to bounce up, and the second half of this year might hold new highs for the DAX, as I suggested they might in the S&P 500, if indeed the 18-month cycle trough in October of 2014 turns out to be the correct analysis. But then price will come down into the 18-month cycle trough, which is expected in early 2016, early next year. And at some point it will cross the 54-month FLD. Where it does, it will of course generate a target to the downside, and so as a very rough estimate, we're looking at price coming down to perhaps about the 8,000 level, depending of course where the peak occurs and where price crosses the FLD. And it should form the 9-year cycle trough, or at least 4.5-year cycle trough, sometime late in 2017. So that's a really long-term picture. Now I need to wrap this video up and discuss why this analysis uncertainty, or the different possibilities in terms of the position of the 40-week cycle and the 18-month cycle, why it doesn't need to affect our trading. First of all, let's discuss the original analysis that I've been presenting over the last few months, which has the 18-month cycle trough in the middle of October 2014. Why does this not affect my trading? Well, as you know, I trade according to price interactions between price and the FLD. And I track the 20-day FLD, and so here you can see the A category interaction for the current 80-day cycle, which of course started in the middle of December, and that was the A category interaction which occurred in December. The A category trade did not reach its target. That was a bearish sign. This was the B category interaction, which I didn't trade because I don't trade B category interactions as a general rule, and it dropped way down below the FLD, which was a surprise and another bearish sign. Price then came back up to the FLD in a C category interaction, and it touched the FLD but didn't cross it and didn't reach new highs, which is a third bearish sign. Lots of bearish signs developing over here. Price then came down in a D category interaction, which was very messy, would have been pretty much impossible to trade unless you wanted to look at the shorter FLDs, which of course you could do, and you could have got into that short trade, but it came down to form the 40-day cycle trough, which it is very possible, if not likely, that it formed last week on Friday. Now, so there's our D category interaction somewhere in there. Now, our next interaction is a long E category interaction. That's a long trade as price crosses up above the 20-day FLD. Am I interested in taking that trade? I've got to say, not really. Okay. I've seen a lot of bearish signs developing in this market, and I think that the stronger move, if you like, is the move down into the 20-week cycle trough. Here's the nest of lows for the 20-week cycle trough, which we are expecting to form in early March. So I am not very interested in entering into a long E category trade. However, I do think it will provide me with a good opportunity to position for a short trade for the move down into the early March or late February trough. So my trading opportunities here are: there is an opportunity to enter into a long trade as price interacts with that 20-day FLD. Not an opportunity I'm very interested in. But then I would be interested in the short trading opportunity that will follow that, and which will take us into the 20-week cycle trough, which forms in early March. Now, let's take a look at the other analysis possibility and discuss the trading opportunities according to this analysis. Well, here is, of course, the 40-week cycle trough in the middle of October 2014. That's the big difference between these analyses. Here is the 80-day cycle trough, which formed in the middle of December. No difference there. And here is the A category interaction as price interacted with the 20-day FLD. And it gave us a good trade up to the peak at the end of 2014. There was a bit of a bearish sign there because the A category trade target wasn't reached. There is the B category interaction as price crossed down below the FLD. Again, another bearish sign because price usually finds support at the FLD. So another bearish sign. There's the C category interaction. This is all exactly the same, as you can see. Do you notice how these interactions are pretty much identical? The levels are slightly different, but the actual interactions, the trades that we would have been making were no different. And that is what I mean by the fact that even though there is some analysis uncertainty, our trading is not really affected. That C category interaction was also bearish because price didn't cross over the FLD and didn't achieve new highs. The D category interaction was for the move down into the 40-day cycle trough. That 40-day cycle trough also very possibly formed last week on Friday. Price is now bouncing out of the 40-day cycle trough, so we now have an E category trade available to us. Again, would I be interested in taking this long E category trade according to this analysis? Well, no. In fact, I'd be even less likely to take the E category long trade according to this analysis. Why? Well, because in the other analysis, there is an 18-month cycle trough over here, which means that the 18-month cycle is still pushing up according to that analysis. According to this analysis, there is no 18-month cycle trough in October of 2014, but there is an 18-month cycle trough expected. As you can see at the bottom right of this chart, there's the circle and whiskers, the whiskers for that nest of lows for the 18-month cycle trough, and that tells me that the 18-month cycle is currently moving downwards. In other words, there's more bearish pressure, so I am less likely to take a long E category trade. If you believe in trading every single interaction, which you shouldn't, by the way, but if you do, then you would certainly take a smaller position size in this E category long trade, because the signs are very bearish at the moment in the market. So what's expected to happen? Well, we expect some kind of an E category interaction. It is expected to be a cross, but it might disappoint us. It might just come up to the FLD and then start moving down again, and at some point it will form a peak. I don't really want to provide a level because we don't know yet what that level will be, and price will move down into the 20-week cycle trough, which is expected towards the end of February, as you can see. Do you notice how my trading opportunities here are pretty much exactly the same? Yes, there is a long E category trading opportunity according to this analysis as well, but not a very enticing one. I'm not very interested in that trade. What I am much more interested in is in positioning myself for the short trade, which will take us into, in this case, a 20-week cycle trough expected towards the end of February. Now, there again is a subtle difference. We are expecting a 20-week cycle trough in both analyses. But in this analysis, we're expecting the 20-week cycle trough to occur slightly earlier, towards the end of February, as opposed to the other analysis, which expects it in early March. Nevertheless, the trading opportunities, to my mind, are almost identical. There is a subtle difference in underlying trend, which will affect my position sizing, but the actual trades I will be taking are pretty much the same. Thank you very much for joining me this week in the Hurst Trading Room. I do hope that you have found the video interesting. Please do get involved in the conversation about Hurst cycles. Get involved in spot instant messaging and send us a message, ask questions or provide answers, or let us know what you believe is happening in the markets. I look forward to seeing you next week, and in the meantime, wish you profitable trading.